be aware that there's the implication of dividends. When you short sell, you are required to pay out the dividend and possibly franking credits if the share goes ex-dividend while you're short. And that's because if you're short selling through a full service broker and you borrowed somebody's shares, they want to get their dividends basically and their franking credits. So you have to pay that money. And the CFDs, because they're a simulated market, you have to do the same thing. So you have to also pay the dividend because they're simulating the same market as the real stock market. You don't have to worry about the franking credits because you don't earn franking credits with CFDs, but you will have to pay the dividend and it just comes out of your account on the ex-dividend date. So, you know, basically, because with short selling, somebody has the right to that dividend and that's why you have to pay it. So one of the benefits, I guess, that you could consider, if you're looking at a share and it's falling and you decide, look, I would like to short sell this, what you can do is check when it's coming up to dividend. So if the dividend's far enough away, then short sell it. But if the dividend's in the next day or couple of days, you might want to wait till it goes ex-dividend, because whenever a share goes ex-dividend, it will gap down and it will fall in price for the dividend amount. And this can sometimes drive more momentum and cause it to fall further. So you could actually then short sell it after the dividend gap occurs. It all depends on how far away it is. But if it's really close, then that's something that you can do. So you just need to be aware that you will have to pay the dividend if you're in it. But if it is coming up to a dividend, you might like to hold back and wait till the dividend drop has occurred and then enter short afterwards, and then you're not liable for paying the dividend amount.
Do you notice, Justine, with that, is it often just like a net position, because obviously if you're going short and then it gaps down, you're going to make money on that, and then obviously you have to pay out the dividend. So is it more of a case of, like you were saying, it's like the stock may pick up momentum? Is that the reason for avoiding it? Because hopefully they should come close to counteracting each other?
Yeah, because you get the dividend gap and you're paying out the dividend, it usually counteracts itself. But it depends how large the dividend amount is. So if, because some stocks can have good dividends, especially if it's one of the blue chip shares, and it can be, frustrating to, sort of give that back. But it's a personal thing, but I always check the upcoming dividends, and if I see something I like and it's paying a dividend tomorrow, I'd probably wait till tomorrow to short sell it, just in case it doesn't fall the full dividend amount. But more than likely, if it's falling, it's most likely going to. But it just means you're not in that position of paying out the dividend. But if it's got a week or a couple of weeks to go and I'm in a trade that might be then paying a dividend, I won't exit because it will have that dividend gap. My stop loss will move my way to recover that.
Yeah, cool.
So, but it's just being aware of it. And sometimes you see a share come up, and it's important to be aware of it, because sometimes a share can come up in your short system, and that's because of an ex-dividend gap, but that's the only reason it may have fallen. This is when we're obviously in a bull market, so you don't necessarily want to be short selling if we're in a healthy market because of an ex-dividend gap, because if we're in a healthy market, it may fill that gap, and the only reason it dropped was for the ex-dividend gap.
Yeah. Good insight.
So let's have a look at some of my actual short trades. Sometimes it's easy to understand short selling when you've got some trades to look at, and I've got a range of trades in here, from winning and losing and a range of different exits. So last presentation I showed you a channel trade on Jindaobi Metals that I undertook on the long side, and I continued to trade this channel. So I had traded it on the long side, and when it rose up to the top of its channel line, I actually exited that long trade, and then I continued to watch this chart, and as it fell away with a strong black candle, I then short sold it. And I short sold it trailing a stop loss, and my goal was basically to exit when it hit the bottom of its channel line. And this was with a CFD trade, and because I can set all range of stops up, you can do what's called an OCO stop loss, which is one cancels out the other. So I'll have my my initial stop or my trailing stop set, and then I can link a profit stop to it. So I had a profit stop linked that if it fell to $1, then I'll take profits out of the trade because that's at the bottom of its channel line. So I was automatically sold out when it hit $1 and bounced, and $1 being a significant round number is also a point where it was likely to bounce, and it was also at the bottom of its channel area. But as it turns out, it was a nice little hammer pattern on the chart there, with a wick that was showing a rejection of.
Yeah, great exit point. Like yeah, you picked it extremely well. I know it can sort of, when it rallied back up, you could imagine if you held it beyond that point, that would have been quite hair-raising to see it rise so strongly. So excellent point.
So, but that's the only time with a channel trade that I can see myself getting at the tops and the bottoms. With a normal trade, I simply get in and my stops hit. So it's not possible with other trades. So these are just something that you can do if you see a channel. And you know, when that reverse happened, I got back in there on the long side, but it failed, and I only exited out at a very small loss. So I had 2 beautiful trades on it and 1 small loss on within this channel.
Excellent.
So yeah, so that was, I held that trade for 20 days, made a 26% return on the total trade size, which was 261% on the CFD margin I had to outlay, so it was 10% margin that I had to put up for the trade. So let's go to the next trade. I wanted to show you an open trade because at the moment I haven't been doing a lot of short selling over the last couple of months to show you a whole lot of short trades because you know, throughout last year I was mostly long in the market, and through the global financial crisis I was net short, so I've got a few trades to bring up from the global financial crisis, but most of my short trades are currently open now. So it's probably easy to show you an open trade. As you can see, this share had been sort of trending downwards, but had strong support there, which you can see from the line on this chart. There's a nice support line there, and when it broke through that support line, it came up in my scan that day, in my short scan. I liked what I saw, so I short sold, and I'm trailing a stop on there which has moved into profit. So the share has fallen very strongly and lower, and I've still got that trade open now, so I will continue to watch and see what evolves with that trade. But that's pretty much what a short entry looks like that I'm looking for. And I then trail a stop loss on the trade, which is set above the share price. So you can see a blue line above the share price, that's my trailing stop, and you can see some little blue arrows. Those little blue arrows mean it came up in my scan that day when I ran the scan. Okay, so going on to another trade. This is some of my top trades from the global financial crisis that I took on the short side. This is Pacific Brands. This share had been come up in my daily trading system, but because it had immediate support, I didn't enter it till it had broken through that support level. And once it broke through that support level, I liked what I saw, so I short sold it. It moved very strongly my way and kept moving down. And then I sold half. I took windfall profits because it had halved in value. Now, one thing with short trading is you will never make over 100% returns because, you know, without margin, of course, because a trade can't go beyond 0. When you're long trading, shares can double, they can triple, they can quadruple. So you can make beyond 100%. But there's a cap with how far a share can fall on the short side. It's just, it can't double. So there comes a point where you might say, well, it's fallen to such a low price, and this is where I exited half because it was a good time, I felt, to take some windfall profits. It had fallen quite heavily. I didn't know if it was going to continue, which it did. So by selling half, I've left half my trade open. And then as it continued to fall, I still had a trade open. And I actually exited out on Christmas Eve because I thought, I don't know how much more is in here. It was at 34 cents. And I thought, well, it can't go beyond 0. And it's only going to be a couple of $100 I'm leaving behind now. So I was happy to sell out, go away for Christmas, come back and start trading.